Welcome to 20 Minutes of Clarity, your go-to podcast for financial insight and advice. As always, I'm your host, Jason Noble, and with me today is Andy the Man Merchant. As we start the new series around year-end planning, we are going to go right to the questions that we've been getting from our listeners as we wrap up this year to really kick off this new series for the end of the year planning. And what better way than answering the questions that we're already getting from our existing listeners? And how they're doing that is they're going to Clear Picture Financial, they're entering their information, and with that information, they put down some of the preliminary questions that we're able to address in the meeting that we have. But we also thought, like, let's cross use that, right? Let's use this for the conversation we're about to go and embark on. So, Andy, as always, it's always a lot of fun to get caught up with you and also talk through different ways that we could address these kind of questions. So let me look over to my left now, and I'm going to get right into it with this is an interesting question that we received. Are there any smart moves I can make before the end of the year to reduce my taxes and keep more money in my pocket?
Well, isn't that one we always get, right? Of course.
Yeah.
What do you tell people?
Okay. So yes.
Yeah.
Okay.
I'm going to start with you. That's your question.
Me?
Yeah.
Well, okay. Well, then the couple things that I would be considering is on the qualified side, on the retirement side. Where are you at with your 401k? Were you able to max that out? Are you in a position to do so, right? And if so, have you done it yet? And if you did max it out, when did you max it out? If it was in the middle of the year, you're not like getting the full matching. It would want to be in a Q3 or Q4 of the year that you want to start to then max it out, okay? But that would be on the retirement side. Depending on your income limits, like if you're near certain ranges, you may want to wait until the next year to do your prior year contribution into IRAs, right? Especially if you're near certain phase out ranges. But other than that, if you're not near those ranges, did you make your contributions into your IRA? And if you're in a lower bracket, maybe consider Roth contributions. And the reason for that is as you grow in your career and your income, then maybe you switch then later on. But you're going to be thanking me when you retire and you don't have to pay those taxes on the distributions. And then on the taxable side, the non-qualified side, when I say non-qualified, I'm talking about joint accounts, trust accounts. This will be, is there anything that you could do to wrap up your tax loss harvesting for the year? Andy and I believe through our clear picture process that you should be tax loss harvesting throughout the year, right? But if you're doing this on your own, take a look at what you had that gained and what you had that went down, and you could be able to sell those positions that went down along with the gains to rebalance your portfolio, or you could take those losses and have them carry forward for maybe down the road another taxable event that you have coming down the pike. So those are some of the year-end things that I would say on the tax side of the equation. Andy,
the only
still
thing
got to bring in another perspective.
The only thing else I would add is really more just, I would say more of ways to avoid the tax surprise. Because like you just referred to, ensuring that you've done tax loss harvesting. Well, it's too often sometimes trading within a taxable portfolio by your advisor could have been going on throughout the year, and you may have been at a point where you've realized gains. Now, realized gains, could be if they're short-term, ordinary income, long-term, past, 12 months in a day, could be at ordinary income or, at dividends or the capital gains rate. I bring that up because if it hits December 31st and you've got some of these gains, I don't want you to be surprised at April 15th when you realize that you owe some money on that, when you could have maybe been a little bit more proactive in your tax loss harvesting. So make sure if you're talking to your advisor now, or if you do your own management, just look at your realized gain tab or ask for a realized gain number and see what it is. It may just be what it is, but that does happen. So avoid the tax surprise. I love how you brought up the Roth conversion, and when the question is are we saving? How do I reduce my taxes and savings? Those are ones that are the thank you later for sure, because if you're in a lower tax bracket, you might want to pay taxes in order to save taxes tomorrow. So No, I think those are all good ones. The only other thing that I would throw, and this is just more of a, you got to start exploring. You don't have a lot of time left, but if you're a business owner, there are some strategic things that you can do in order to make sure that you're maximizing or reducing the tax impact that you have on your business income, especially if you're self-employed. Are you making sure that your deductions are properly outlined? Are you understanding the tax credits that are available? Have you looked at any kind of depreciation? So those are things you need to meet with your CPA on. But those are some proactive things you could do if you're a business owner at this point.
Just one last thing, and I think this won't be necessary year-end planning, but if you're holding a taxable account, like a joint account, trust account, individual brokerage, right? Is you yourself or your advisor using active managed mutual funds? If that's the case, you will be able to identify that next year when you get your tax forms from the brokerage account. And what I'm referring to is past due taxes. When those active mutual funds are buying and selling those investments throughout the course of the year, they don't pay those taxes. Well, wouldn't that be nice, Andy, if that was the case? No, they pass through to you. And you're like, well, wait a second. My investment went up 6%. Why am I paying all these taxes? Like I realized like I had such a massive gain. It was because of other investments that they were buying and selling inside the investment. Yeah, the investment went up 6%, but with all the buys and sells, they pass through those taxes. Hence, you're paying a lot in taxes. So be mindful of that. And if that is the case, be pissed, be upset, and fire your advisor immediately because they are not looking out for what's in your best interest by using active mutual funds in a taxable account. That's just going to create more past due taxes for something that's going to have like you could be able to reach your goals better by keeping Uncle Sam out of your pockets. I'll leave it there.
Yeah.
Andy, well, what other questions did you get?
Yeah, I'm going to answer a question, but just to tie the bow on that one, I think the summary, because I think that helps people. We cover good stuff. Is make sure your investments are aligned to your goals, that you're not overpaying. Don't be surprised whether it's in mutual funds or realized gains. If there's a tax loss harvesting component, go ahead and make sure that you're being proactive in that nature. Take advantage of your deferred accounts. That's the only way a lot of people with active income can actually defer income in a current year is by putting into a qualified retirement account. There are a number of different strategies there. If you're still like, hey, I got a lot of active income, I think I've done it, that's when you call us, and our team that specializes in it can help you there. And then the other one is just kind of making sure that you're taking advantage of all other tax savings, whether it's a health savings account for year end. If you're a business owner, some of the deductions that you do have to have in by 12/31. Those are the key things. So I think if taxes are a pain point for you, if you're concerned about it, and this question applies to you, you know where to find us. The other one that, Jason, I want to jump into, I think this is kind of a quick one for us. I knew taxes would take a bit, but do I need to take any RMDs this year, and how should I plan for them? RMDs, required minimum distributions. Hopefully your advisor, right, I always tell people, are the ones that are helping you and have already made this phone call for you, right? If you're just that person now that doesn't know, hasn't had communication, doesn't know if you need to take one or not, then obviously that's a cause of concern alone, because there is a hefty penalty for those that are required to take those distributions from their qualified accounts, their IRAs, if you don't. Right, so I think that's the first
thing. It's a 25% penalty, and you still are required to do the distribution and pay the penalty and pay taxes on that distribution. So required minimum distributions are on pre-tax qualified accounts. So think of inherited IRAs, think of rollover IRAs, think of traditional IRAs, or even 401ks, 403bs, 457. And you meet the required minimum distribution age, which is 73 right now, okay? Just someone right there, I just know, Andy, they're like, well, I had to do it at 70 and a half. Yeah, they changed the laws. They changed the laws. Now it's 73, and eventually it's going to be 75. Okay, so if it's your own retirement and you're forced to do required minimum distributions, let's say If you're asking this question, I'm already assuming that you turned 73 in that year, and right, you turned
Yep.
73 this year. My there's a two kind of caveats here. You can wait and do your RMD next year in 2025, as long as you do it before April. That means in 2025, you got to satisfy your 2024 RMD and your 2025 RMD. That may not be the best thing from a tax perspective with all this money coming out in 1 year. There's always an exception to that rule. We're not here to cover those exceptions. That's when you would have to reach out so we can cover that with you then. But typically speaking, I like to do the 2024 RMD in the calendar year 2024 and not delay that first RMD into the second year. You can only do this in the first year that you turn RMD age. So like what I'm saying to you, for those who are 80 years old right now that love podcasts and financial information, yeah, you can't take your RMD for 2024 and 2025 because it's not your first time doing it. You've been there, you played this game before, okay? It's only the first year that you could kind of play that little game. So that covers like how we look at required minimum distributions for those who turn themselves a certain age.
Mm-hmm.
Now, the inherited IRA, Andy, I know you said that we may not spend as much time on this as we did with taxes. It depends on when the person passed away. Did they pass away a couple years ago, like more than 4 years ago? And then you have what's called stretch IRA distributions, stretch distributions, RMDs. Get this. The way that it's looked at by the Internal Revenue Service, IRS, who we all love and adore, okay? In case you're watching and listening, if we like you, okay, don't audit us.
That's a good one.
What I'm gonna say is it's on you. It's on you, the person, to make sure that your RMDs are taken out through the stretch. Not the financial advisor, not the custodian, and not the accountant. Now, the advisor, the custodian, and the accountant should have had a conversation with you. And if that hasn't happened, you don't have the right team in place. I'll put it plain and simple that way.
I appreciate you and really bringing that to everybody's attention, Jason, right? Because a lot of times, I know in both of our offices, our team is very diligent about making sure that we're reaching out, we're touching it, we run reports, we have it a part of their financial plan, we know their income distribution, but it's really for those new RMD age individuals that may not know, right? Oh, I didn't know I had to take this. And when it does come down to it, you're not going to get a letter in the mail that says, by the way, reminder RMD. That's something that is a service expectation. So if you're in that age, you're in that realm, that realm of age, then you need to start to take RMDs. And again, I think the other thing, throwing out real quick, Jason, on that is RMDs. If you've been taking distributions throughout the year, this is not in addition to that number, right? It's required minimum. That might be understood, but a lot of times we get the question of, if you've been satisfying just normal income from your IRA, you may not have an RMD because you've satisfied that throughout the year. So I think that's important to note. I love the fact that you're bringing up the inherited IRA as a common question. It's very hard to for some to understand. Why do I have these distributions? So I appreciate you bringing that one to the attention as well, especially understanding the 10-year rule. Before too long, we're going to be having a conversation. Have you fully satisfied that distribution? The two other ones I want to bring up real quick, and I'm going to have you answer on one as well, Jason, is if you're a business owner and you're turning 73 or have turned 73 and you own more than 5% or 5% or more of that company, your 401k within your employer is now an RMD eligible asset. So, don't think that if you're out there today and you've got $2 or $3 million in your 401k and now you turn that golden age of 73 and you own 10% of the company, that $2 million 401k now has to take RMDs. And that sometimes gets missed a lot, right? Especially because they're confused on it. So have some planning. That also goes into business strategy planning, that if you're turning 73, say next year, and you're planning on reducing your ownership, you have to have that done by the end of the year. Otherwise, starting January 1st, you are considered that ownership for the whole year, no matter when you turn 73. So I think those are some really cool points to point out there. And the other thing is, if you have a Roth IRA, those are not RMD eligible vehicles. So it may fall under a distribution out of an inherited IRA rule, but you are not forced to have to take it out of a Roth. That's just why Jason and I talk so much about the benefits of a Roth IRA from a legacy and a living benefit going on. So did I capture anything? Anything to add to that, Jason?
No, I think as we wrap up the top three like questions that we receive for end of the year planning, I'll go into, I like this one. It's very broad based, and I think it will be a good way to wrap up. What should I be thinking about now to get ready for next year? Like, how can I set myself up for financial success?
That's a big, broad brush.
It is, and I know you could paint that picture like Mona Lisa. Let's roll.
Or Bob Ross, that's my new thing. No,
Oh,
you got it's the children. Really, I love the end of year conversation on that, because you know what, December 31st to January 1st, or 2020, 4 to 2025, it's a mindset reset. And so this is a chance to re-reflect on your goals. This is a way to start preparing for, what is my 2025 going to look like? Do I have the major expenses that I need to plan? Am I buying a car this year? Are we going to buy a vacation home? Am I going to retire? Am I going to have to spend more time taking care of my family member, my mother or father, because they're older, or whatever it may be? Start thinking about what lies ahead and how much it differs from last year. I think that's a kind of a first place, is just kind of do your typical vision casting of what your next year is going to look like.
one of the things that I like to add on there is take a look at where you've been to see where you want to go. Take a look at like your cash flow, money in, money out, what to do with the difference. I always start with that because I believe that's the heart of any good financial plan, right? And so if you're retired, money in coming in from your accounts, Social Security, other income sources, money out, what are you spending your money on? Are they essential expenses or discretionary? You're going to get a combination of both. You determine if you put an E or a D next to this. I had this conversation with AARP when they reached out for me for this comment and a couple years ago on this topic, right? And like, but you put the essential or discretionary indicator next. But when you go and you take a look and you go, wow, look how much money we spent eating out last year. Yeah, we liked it, but I can't tell you multiple memories from it. Maybe you go, okay, maybe we don't eat out as much. I'd rather spend that money making a memory with a grandchild or doing something like that. And if you're working, okay, totally different conversation, but still the same. Money in, money from work, whatever, your other income sources. Money out, what are you spending your money on? Do the same exercise, E or D, and go, okay, are we on track by saving enough? Or are we enjoying the fruit of life too much now that we don't have the money for the long-term savings goals and that we need to incorporate that for the 2025 year?
Mm-hmm.
And I just want to thank everyone for taking time during a busy schedule between the weeks of Thanksgiving and Christmas and the holidays as we wrap up the year by taking the time to come in into 20 minutes of clarity to hear Andy and I go into the things that you should be considering. Take some time. You already done, this first step by taking a listen into some of the Q&A that we already received from our other clients and for those who reached out. Do the same thing. Do what we just discussed. Go to Clear Picture Financial as well. Enter in your information. Write down your questions right there on the comment section. And one of our specialists will reach out to see how we can help you wrap up your 2024 and prepare for 2025 and beyond. Andy, as we wrap up, what other things would you like to say to our listeners?
I loved how you just segued there and provided that, because I know we put a lot of work this year into providing content, and hopefully it's simplified. I hope that everybody's out there, if you really want to kick off 2025 or kind of do your year-end planning, don't wait. I mean, I know this is sounding like a plea now, but the reality is too many people procrastinate. We've studied it. They wait. We built the Clear Picture Wealth Program, and more importantly, the Clear Picture Analysis, to give you that complimentary snapshot and a little bit of direction on what you should do and where you should prioritize your time. So if you've got questions around cash flow, if you have questions around can you retire, if you still have questions around making sure that you're going to be able to leave the legacy to your family that you want to, or give the gift to your charity or your community that you want to, if you have questions around if something happened to me this year, is my family going to be okay? If any one of those are your top pressing questions or just on your mind, that's when you just take up on Jason's offering and visit us, check us out. We are here. Our team is ready for you. We really hope that we get to meet you in 2025 is the more important, but prioritize your plan, prioritize your time. We got some great, year-end topics to follow on this, but I just appreciate this conversation. I love questions from listeners. It kind of supports why we do what we do.
Absolutely, Andy. Well, that was Andy the Man Merchant. I'm Jason Noble. That was 20 minutes of clarity. Maybe next year we could do 25 minutes of. No, that's too long. We'll just stick it to 20 minutes of clarity and keep it rolling. Thank you so much for listening. We appreciate you.